Hello and welcome to the Lolly Investor Programme. This week I'm looking at quantitative easing, the Bank of England's controversial policy for stimulating the economy and avoiding a Great Depression after the banking crisis 4 years ago. QE, as it's known for short, is the #1 financial topic at the moment. Debate is raging over whether the bank's programme of creating £375 billion of new money and using it to buy government bonds as a way of getting it into circulation is working, and whether it harms pensioners. If you're not a pensioner, you've probably heard of QE, but may not be sure what all the fuss is about. So, here are 2 freaky facts to get you up to speed. £375 billion is a colossal number. In fact, it's nearly 6 times larger than the total amount of banknotes in circulation in the UK. Think about it. What if next time you take out money from the cash machine, it gave you 6 times more than you were expecting? That would be exciting. It would be incredibly dangerous too. If the Bank of England had actually printed all this extra money in the past 3 years, we'd risk having the sort of hyperinflation that damaged the Weimar Republic in Germany after the First World War. Bank of England Governor Mervyn King insists QE is not about printing money. He says it's about increasing the quantity of money moving around the system. It does this by creating the money electronically, out of thin air at the press of a button, which to my mind makes King sound like the Wizard of Oz. It's essentially a confidence-boosting trick designed to get us thinking things are ticking over even when the economy is in really bad shape. The Bank of England reckons that creating all that phony QE money was equivalent to cutting interest rates by between 2.5% and 5%. That is a huge amount of monetary easing, as the bank would call it. Remember, the interest rate is the bank's main way of controlling inflation and managing the economy. When the economy overheats and inflation rises, it increases interest rates to cool things down. When the economy slows and inflation falls, it cuts interest rates to stimulate activity by making it easier to borrow money. In March 2009, when King launched QE, it already slashed interest rates to a record low of 0.5%. They couldn't go any lower. They're still stuck at that level, which means that in a parallel universe, British interest rates are somewhere between -2% and -4.5%. Negative interest rates are a really weird concept. Imagine a situation where you really did lose money every time you left it in a bank. Imagine banks competing for your savings by boasting not how much they would grow your money, but by saying, we'll lose you less money than our rivals. These freaky facts underline the extraordinary financial situation we're in. We don't have negative interest rates yet, but quantitative easing has distorted financial markets and made life difficult for savers. All those purchases of UK government bonds, or gilts as they're also known, have pushed their price to all-time highs. This in turn has depressed gilt yields, which measure the amount of interest that government bonds pay to new investors. This is important because gilt yields affect annuity rates, and annuities are the insurance contracts many people buy with their retirement savings to pay them a pension. Low annuity rates means a low pension. The Bank of England argues pensioners have not lost out, as the rise in gilt prices will have given them a bigger pension pot when it came to buy their annuities. It also claims we've all benefited. Falling gilt yields have pushed down long-term interest rates, which has helped the economy avoid a really nasty recession. Low gilt yields also encourage investors like you and me to buy riskier but higher yielding assets such as corporate bonds and shares. Their prices have also gone up more than they would have otherwise have done, so many people are arguably better off as a result of QE. I can't fault the bank's logic, but I do worry where it all ends. The fundamental object of investing is to put your money in good value investments. But what is good value when money is free and can be created at the push of a button? What if QE causes inflation to spiral out of control in future? We just have to hope that the cure doesn't end up being worse than the disease.